Well, back on interest rates, announcements around interest rates are not only about calculating the costs of your immediate repayments for your bond and other loans, but they also affect how much you'll have during retirement. Cyclical movements of higher or lower interest rates could determine the amount you end up with when you are in retirement years. To help us understand this, we're joined by Lizl Budhram, Head of Advice at Old Mutual Personal Finance. Lizl, looking at the higher interest rate environment that we have now in the country, how does that affect our retirement at the end of our pension years?
It will, good afternoon, good evening, Matteo. It will have an important impact, but it depends, the impact on each individual's retirement plan will depend entirely on where they are in terms of the time frame to retirement. So if we look at people that are far from retirement, it's less likely to have a significant impact because those people will still have time to work through a number of interest rate and market cycles before they arrive at retirement. If your retirement time frame is shorter, let's say you are within the last 10 years before your retirement date, the impact will be bigger. And it's very important to take care to make sure that you manage that impact and you choose your asset classes carefully so that it isn't a profoundly negative impact on your retirement value when you arrive at retirement. And then we should also not forget about the people who are already in retirement, because you have an accumulation phase where you plan for retirement, but once you arrive at retirement, you also need to make sure that what you have accumulated is going to last for the rest of your life to give you an income. So for those people, it's also very important to take into account where we are with the interest rate cycle and to make sure they choose the right asset classes to provide them a sustainable income.
Now, retirement funds are investment meant to be kept for a long period of time, and during that long period of time, you'll have higher interest rates, you'll have lower interest rates. So when that happens, should we be calling our advisors to say, look, the economy right now at this point, we have high interest rates. How can this better improve my retirement years?
Exactly. So I think if you speak to your advisor, it's very important to share your personal experience, your views, your preferences, but it's also important to listen very carefully to the profound knowledge. What we know that markets are cyclical, interest rates are cyclical. So if you've got a long time frame until you get to retirement, it's very important not to take short-term decisions and short-term actions based on where we are in the cycle right now, because the cycle is likely to change a number of times. And you can afford not to respond to the cycle where it is right now, as long as you have properly diversified asset classes in your portfolio that will take advantage of high interest rates, but also take advantage of long-term equity cycles to make sure you don't miss the market movement. If you are invested for the long term, if you're still young and you've got a reasonable period to go until retirement, it's really important to take enough risk to make sure that you do benefit from equity cycles as well, and not just take the safe route and sit in interest-bearing investments where you get great interest rates right now, but it may not serve you in the long run in terms of optimizing your returns on your retirement investments.
But the reality of it, Lizl, is that we have an economy that's low growing. We have high interest rates, high inflation, households under pressure. Some who already have retirement savings might be perhaps prompted to try and call their advisors to withdraw funds. Would you advise against this firstly? And also, how good is it to sit on your hands and just let the cycle continue?
It's such a good question. I think especially now in the light of the proposed two-part changes where we are going to see increased access opportunities to retirement funds, that will need to be managed very carefully. Currently, we see behavior in South Africa where, because of financial pressure, you can only access your retirement funds, your pension funds, if you resign from employment. And many people actually do take that drastic step to access the money because the pressure on their financials is just such that they need the money. I would be the last person to say never do that, but it really should be an absolute last resort because you are prioritizing your current financial needs and sacrificing your long-term financial independence when you get to the point where you have to retire from employment. So it's very important to balance those two. Sitting in your hands is not always the right thing to do, but in most instances, it could actually be the best thing to do. We have seen an incredible amount of value being destroyed by investors making nervous moves, saying, oh, there's no growth in this economy. We have to take our money out of the market. We may as well spend it because we don't expect growth. And in the long run, those decisions are usually not the best decisions, and they don't create the best financial outcomes for savers or investors.
Retirement savings are essentially there to help us prepare for the things we need to pay for when we're retired, when we're not working and getting an income any longer. How do you create a strategy as an individual to have enough saved up to deal with the high inflation you might face when you're retired?
If I look at the behavior in South Africa, as we said, many people don't leave the money alone. So that's usually a good thing. Just leave your money alone, let it accumulate. You have the power of compound growth. It will often make an enormous difference if you can just leave the money alone. Almost forget about it. I know you often hear people say, but it's my money, and if I want to access it and spend it, why shouldn't I? Understand it is your money, but you are effectively stealing from your future self to use the money right now. That's the one thing. And the other thing is to make sure that your portfolio is properly diversified, because then you don't constantly have to watch and switch and time the market and guess which asset class is going to give you the best return, because you've got a well-diversified portfolio. And making sure that your portfolio is diversified properly and you've got the right asset classes selected, the right ratio, the right exposure, is where a financial advisor can really come in and help you make sure that you've got that peace of mind, that you've got the right structure, and you've got the discipline to just leave the money alone as far as possible.
When it comes to interest rates, we always harp on about repaying your house or repaying a vehicle, for instance, and how expensive it will be to repay a loan. But there is a benefit there if you are saving your money. So if it comes to retirement, when it comes to lower interest rates, does that affect your retirement savings?
Lower interest rates will affect your retirement savings in the sense that usually then you are going to benefit from better equity growth. So better growth in the market will result in better accumulation and growth in your retirement funds. You mentioned an important point, Ms. I think what's really important is that balance between debt and should I repay my debt and should I save for retirement? How do I find the appropriate balance? And it's not a one-size-fits-all answer, because it depends on the type of debt, it depends on the tax rate that you are paying, it depends on the interest rate that you are paying. So again, a financial advisor can analyze your situation and help you decide what is best. What is really interesting is a recent survey that we've done with retirement fund members. We asked them that when the two-pot system goes live and you can access money out of your pension fund, would you? And a fair proportion of people said they would access the money to repay debt. So if you are in a position where you are not making your debt repayments on a monthly basis and your debt is completely out of control, that may be necessary, unfortunately. But if you're thinking of it merely to repay your bond because you like to be debt-free, you're taking money out of your pension fund to move it into your bond, there's a very careful calculation that you would need to do to really make sure that it's the right thing to do. It isn't necessarily the right thing for everybody. So you need to think very carefully before you make that decision. The tax implications are very far-reaching of decisions like that.
I wanted you to remind us of those penalties, or rather tax implications of withdrawing money early and also withdrawing it when you are in time for retirement.
So at the moment, we see if you withdraw money, there's a table at which the withdrawal amount will be taxed. That does penalize you at retirement. So there's also, when you get to retirement, an amount that you can take as a lump sum. And in our experience, when we deal with clients who reach retirement, it's usually very important to have access to that lump sum, because often people then still have a bond or they still have debt that they would like to repay before they commence into their retirement years. So again, understand that you are taking some of that money earlier. If we look at the two-pot proposals, when you take money out of your savings pot in the future two-pot world, that will be fully taxable at your marginal rate, which is it is the highest rate at which you can possibly pay tax. And there's no exempt amount. The full withdrawal amount will be subject to your marginal tax rate. So the tax implications can be really negative. It's really important to understand that well before you finalize your decision to withdraw out of your pension fund.
Let's look at that two-pot system that government has been introducing and could likely go live next year. How does the industry feel about it, that you could save up on the one end as part of your retirement, but have a longer-term fund as well, and one you can dip into. Is this something you're concerned about, the speed at which it's happening?
The speed is definitely a concern, because I know many people don't appreciate, in the back engine, a lot of work needs to happen to make sure everything is ready, because we want to make sure that the right people can access their funds. There will be the tax calculations. People can make informed decisions. So making sure that everything is ready and the system will work well is definitely a stress factor, because we don't have a lot of time with the current date that looks like it could be March next year. If I look at the impact in South Africa, if I look at the immediate impact, definitely a concern that many people will take the money. When they can access money, they will access money. It may not be in their own best interest in the long term. So that is a concern. But if we just take a step back and we consider the implications of the two pots legislation in the long run, I do think it will make a significant improvement in the South African retirement landscape, because people will no longer be able to access everything out of a pension fund if they resign from employment. They will necessarily have to preserve 2/3. And it's only the 2/3 that start accumulating from March next year, if that is our effective date. So only from then, let's say 10, 20 years in the future, that 2/3 pot will be significant. Now suddenly, people that are repeatedly resigning to access their money repeatedly, they end up at the age of 65 with nothing saved up. These people will now have 2/3 saved up over a 10 or 20-year period that can end up being a meaningful amount over that period. So we are excited to see the long-term shift the two-pot will accomplish. In the short term, there's an enormous amount of pressure to make sure everything is ready. And there's also a concern that people will, without really considering the implications, access the savings pots, and that will be detrimental to their own outcomes.
And hopefully it improves South Africa's savings culture. That was Lizl Budhram, head of advice at Old Mutual Finance.